All right, good morning, everybody. I'm going to have to start now because the video is long, right? So this morning is the grand finale of the market structure series, right? It was a 3-series video. If you missed it, you can go into the recorded Zoom folder and you can watch the previous 2 videos on the market structure series. Prior to the market structure series, we looked at a Wyckoff, a three-part Wyckoff series. Please look at the Wyckoff series as well. Today's video will combine all of that, and we'll actually go into the charts and he'll break down setups, right? At this point, you should be able to look at a market, anticipate the move, right? And find trades based on market structure, Wyckoff, and other setups you see, okay? So we'll watch the video and then we'll get back together. We'll talk for a few minutes after the video, and then I have to get on the swing traders call. You guys have any questions?
Comment to make sure that it is the main channel or not. And if you come across any of these fake comments, please do go ahead and report them. But without further ado, let's go ahead and jump straight into the recording from yesterday's video, Market Structure Part 3, mixed with supply and demand and Wyckoff cycles. Okay, let's go ahead and jump straight into it. Now, as a very quick reminder, as a very quick kind of refresher in terms of what we were speaking about before, we were in a way speaking about, let's say, a normal trend going up like this, where you have your low, high, higher, low, higher, high. And within this trend, we would in a way be able to go ahead and identify all of these high points as the reversal back down as these areas of minor supply. So naturally, whenever the market reverses, whenever the market does a U-turn and goes back up, or a U-turn and comes back down, there must have been elements of supply or demand introduced within that currency pair, within that chart, right? So whenever within this trend going up, even within these little pullbacks, the market is coming back down, these are now your areas of supply or minor supply within the range. And as you can imagine, every single one of the lows that we work with, this would be an area of demand, an area of demand, an area of demand, right? This is very basic, very straightforward. And, even if I go ahead and change it the other way, all the blue zones are now your areas of supply and all the red zones are now your areas of demand within a kind of bearish trend, right? Very simple and very straightforward. You should all know this in terms of supply and demand. I'm not going to spend any more time on this. Whenever the market reverses, there must be elements of supply and demand. Looking at this from a Wyckofian standpoint, however, if I want to start to draw it a little bit more accurately and a little bit easier, this is how I'm going to start to kind of draw it. And I'm going to keep looking this way just to kind of, look at my notes and make sure I'm not waffling, let me be real. So within a trend going up, this is how we can kind of start to draw it. Let's say you start your accumulation phase, the market goes up, gives you that little distribution, it comes back down, gives you another accumulation, it goes back up, gives you another distribution, comes back down, gives you another accumulation, and so on and so forth. It's the same trend that I just drew from low, high, higher, low, higher, high, higher, low, higher, high, but now in terms of Wyckoff supply, or Wyckoff accumulation or distribution, which is actually the same as supply and demand. What I mean by that is this distribution that took place up here is the same area of supply that we were talking about. So is this one. These are now areas of distribution at the top of the range where the market is giving you that little retracement back down. Those are areas of supply. And by the way, let me go through everything and then it will make sense. So if right now you're still kind of trying to grasp it, why does this matter? Why is this relevant to the trends? It will make sense. Believe me, there's a reason I've got so many tabs open up there. We'll go through it, right? And all of these areas of accumulation down here, these are now your areas of demand. From a Wyckofian standpoint, a normal trend can look like this: accumulation to distribution to accumulation to distribution. But here's the thing, the trends are never this clean. Let's be honest. They are never this clean. So how does a real trend oftentimes look? A real trend, a lot of the times, can start to look like this. You get your accumulation down here, and the market, let's say, goes up and starts that distribution phase. it comes back down, maybe it gives you a little minor accumulation, it goes up, it reaccumulates before taking that distribution, then it goes higher, give you a little minor distribution up here, maybe it comes back down, gives you another accumulation range and another reaccumulation range over here before going higher. What I'm trying to help you understand is within the same range, you would have areas of distribution. Let me actually start with accumulation as blue. So areas of accumulation, areas of distribution at the top of the range, and the same way that the trend needs to continue, so do these accumulations and distributions. And what I mean by that is you would be able to spot areas of reaccumulation as the market is also going up as well, and vice versa. It goes without saying, when the trend is coming the other way, you would be able to identify areas of distribution as well. So for example, as this market coming back down, you get these lower time frames redistributions within the range as well, as the market is kind of coming lower and lower and lower and lower and lower. Now, okay, so we now look at the same trend from the perspective of normal trend, supply and demand, and then we looked at it from the perspective of Wyckoff accumulation and distribution. And now you can kind of see this trend from the perspective of a reaccumulation and a redistribution. Now, this is where I want to kind of elaborate a little bit more on drop-based drops, rally-based rallies. And I want to kind of speak a little bit about the similarities of this to, quote unquote, institutional concepts, and how practically anything that you've been looking at the chart so far is the same as what the institutional traders do in a way, but just from a slightly different angle. And how I'm going to actually go ahead and describe this is like this. A lot of you have actually traded using rally-based rally or drop-based drop formations. If you don't know what that is, normally that's when the market gives you a little, let's say, move to the downside, a significant drop to the downside. It goes sideways for a matter of a few candles, maybe a few dojis, one doji forming in the middle, a little wick, consolidation region that takes place before this market has the next move to the downside. This is what you call a drop, base, and a drop, and vice versa. You have the rally where the market rallies, goes into that base region, one or two or three small candles, an area where the market hasn't really moved, and the continuation rally away from that level as well. Now, one thing that I need everyone to understand, especially if you're trading supply and demand, is this drop-based drop formation is another version of a redistribution. This rally-based rally formation is another version of a reaccumulation. Not only that, the drop-based drop formation is the same as an institutional candle in the middle of the range. It's the same as those lower time frame of redistribution, obviously, that we spoke about. It's the same, it's actually quite similar to break and retest as well. Let me put it that way. To an extent, for those of you who are trading supply and demand using rally-based rally and drop-based drops, you'd kind of agree with me when I say this is just a little bit more advanced version of break and retest. We just know more or less exactly which break and retests are going to happen and the ones that don't, right? So this is the very, very first thing that I need everyone to understand. That drop-based drops, rally-based rallies, I'm going to actually start to write them here. Many different names for the same concept, right? So for example, you have a drop-based drop, a DBD. A drop-based drop is the same as a redistribution, right? It's the same as when the market is redistributing going lower. I just hit myself with the post, but it's when the market is redistributing and going lower, right? It's the same as that institutional candle in the middle of the range. That's the base area that you identify. All of these are the same thing: supply, demand. Obviously, I have to kind of add let's say rally-based rally over here as well, and the reaccumulation as well, and so on and so forth. What I'm trying to help you understand is these are all the same thing. They're just looked at from slightly different angles. And in today's angle, I want to break down supply and demand to the best of my abilities. And Bish, I was going to go into a lot of detail about indices as well. I'm not going to share anything about that yet. But we want to help you understand that these things look different on the charts, but they're all the same concepts. And how can they look different? Sometimes you would get something like this. You would get one candle pushing down. So you would have, for example, one bearish candle pushing down. And then in the middle, you would have this bullish candle pushing right back up, something like this, right? So bearish candle pushing down, bullish candle, and a continuation of that. You've seen these scenarios left, right, and center, everywhere. That's your institutional range. That's your range in the market where you can in a way see the drop-based drop, your institutional candles, punch candles, whatever you want to call it. I don't care what name you put on it. It's the same concept. That's where on the lower time frames, the market has redistributed and gone lower, which means at that level, there was new supply introduced to the market. I'm going to repeat that one more time. Pay very close attention. At that level, there was new supply introduced in the market. Write that down, put a little pause on it. We're going to circle back to that later. What do we mean by new supply, and why does that even matter? By the way, on some other time frames, this can actually look kind of different. You can even, for example, have, let's say, a bearish candle pushing down, and let's say another bearish candle straight after that. So without any base in the middle. Sometimes it looks something like this, right? So two bearish candles, yet you would in a way be able to actually see the wick, something like this, right? It kind of would look like that. So instead of it being an actual base in the middle, it's just two candles, one of it wicked down, another one wicked up. But as you can imagine, for this to be created, the markets must have come down, gone back up, and come back down. It's the same thing. It's the identical scenario that's being printed. That's your base. That's your drop base drop formation. That's your newfound area of supply that's being introduced to the market. That's your lower time frame redistribution. I can put it the other way as well, and everything is going to be switched right to a rally-based rally and a reaccumulation. But it's just the same picture. That's the first thing that I kind of need you to understand. And not only that, by the way, we've got kind of drop-based rallies, rally-based drops, these type of things as well, where drop-based rally, rally-based drop. In these type of scenarios, that would be your accumulation down here. This would be your distribution up there. It's all kind of the same concept, the same thing, right? Now, when we spoke earlier about a new supply and why that supply is important, this is where I'm going to kind of start to speak a little bit more about entries and how we actually go ahead and take entries using supply and demand and using drop-based drops and rally-based rallies. Okay, now let's go ahead and get rid of this. Right. A lot of people ask, maybe what steps do you take to actually analyze the charts? This is what I do. I look at my trend. I look at my supply and demand. Then I want to look at my proof / validity. Then I want to look at my entries. Very simple, very, very, very straightforward. And what I mean by that is this. I look at my trend. So if in the trend we've got this bullish move, excellent. I'm looking at an uptrend. Easy stuff, phenomenal. Then I want to go ahead and look at those areas of supply and demand. And what I mean by that is the same areas that we started to highlight. Those are now areas of supply. These are now areas of demand. But naturally, if I'm looking at a bullish trend and if I know I want to buy it, more so I'm going to care about the areas of demand, not the areas of supply, right? So I want to find which are the key areas of demand or supply. How do we identify what is the key area of supply and demand? And what I mean by that is how do we go ahead and answer the question as to which institutional candle do we take the trade based on? How do we figure out what is a key area of supply and demand? Looking at this trend, parallel to what we were speaking about earlier in terms of Wyckoff accumulation and distribution and reaccumulation and redistribution, as this trend is forming, chances are we had a minor distribution phase up here, right? So this in itself is actually going to act as a future area of supply. Pay very close attention. This over here in itself is going to act as a future area of supply, which means if supply was introduced once, there's a chance it can be introduced again for this to come lower. Now, if that doesn't happen, it begs the question, why? Why did that not take place? If the market didn't reject this supply and go back down, you should start to now ask yourself the question, number one, why it didn't get rejected? And number two, what was the cause that in a way invalidated that level, right? And what I mean by that is this. If the market is meant to start to reject this and go lower, on the lower time frames, you should start to be able to identify your distribution scenario up there, right? It's as clear as day. If we've had supply, top of the range, the market has reversed and all of these things, and as we approach that again, we start to form that distribution, then obviously it's a lot more likely for this to go lower. But sometimes that doesn't happen. Sometimes the market creates very clean reaccumulations as it approaches these areas of demand or these areas of supply or demand, depending on which way you want to break it. And this is where the reaccumulation comes into place. Do you remember we spoke about accumulation, leading to a distribution, leading to another accumulation? A lot of the times, you would be able to spot areas of reaccumulation right before the market invalidates a specific area of supply and demand. What I mean by that is this. If this was our previous area of supply, the question is what actually started to invalidate it? In a way, if we approach that level and start to distribute, that means we're introducing supply again. But if we approach that level and we are reaccumulating, what does that tell you? If it's approaching that level and it's reaccumulating, this should scream in your face that there's new demand being introduced. There is a higher probability of this market going higher, breaking above that high, than it is actually rejecting it and dropping lower. And surprise, surprise, those reaccumulations on the higher timeframes, they look like rally-based rally formations, where you have the rally, you have the base in the middle, and you have the continuation of that. Now that becomes your newfound area of demand. As simple as that. That's how I look at my supply and demand. So in a way, let's say I'm analyzing this chart. Let me go ahead and take these off. So let's say this is the trend that I can identify, and I want to go ahead and analyze this chart. And I kind of know, obviously, this is, for example, where we are in the trend, where we are in the market. And I can see that we've had a distribution phase up there. And this distribution phase has now led to another accumulation that has, in a way, broken that structure, or a reaccumulation that has broken that structure to the upside. Either way, that area of supply was not substantial. Therefore, it got broken to the upside, right? And I want to kind of ask myself the question as to why, and what is now my new area of demand? Because if the supply was invalidated, that means demand must have been introduced. If the supply was invalidated right over there, that means demand must have been introduced to invalidate that level. Otherwise, it's supply level. You expect it to drop from there, as simple as that. So now I want to start to look at what areas of demand started to invalidate that supply. Very simple and very straightforward. You can find your institutional candles, your area of inefficiency or imbalance. You can start to look at your reaccumulations on the lower time frames, whatever it may be. And once I managed to put my finger on those, once I managed to identify the areas that were in a way sponsoring a specific move, I would want to wait for something called proof of validity, right? This is not really called proof of validity. I'm just kind of waiting for a proof, really. So if I've identified a newfound area of demand, and I'm going to show examples, by the way, for all of these. So if I've identified a newfound area of demand, which has now invalidated the previous supply, this demand, here's the way I want you to look at it. That rally-based rally, that reaccumulation or institutional candle was in a way there to sponsor a break of supply, to sponsor a break of that structure to the upside. So in itself, it has to still prove to me that it holds the weight of the demand, because that demand could have just been introduced by the institutions to get rid of the previous supply, not necessarily for it to hold for future trends. It might not. So what I want to do is I want to wait for some type of a proof of validity. And oftentimes this happens on the lower time frames, where as you get these pullbacks back into these levels, your proof of validity is a break of a minor structure point to the upside. Now that area of demand is deemed as valid. And here, and this is the important thing, right? A lot of you have seen this and now you're confused thinking, yeah, but I've seen that it comes up here, it still reverses and goes back down, even though it's given me that minor break of structure to the upside. I want you to start to look at the key areas of demand or supply. So within this trend coming back down, more than necessarily the exact structure points, we want to look at the important structure points, the ones that you can see that supply was introduced and it has gone ahead and created a new structure point in the market. It's very simple and very straightforward, right? That's the validity of your structure. So that break of that structure to the upside is now going to prove to me that whatever supply we had previously is now invalidated. Chances are we're going to get a retracement and go higher. Trade management comes into this a lot as well, because now you're taking a higher time frame trade based on lower time frame break of structure. So you've got to manage your trades properly as well. I'll speak about that. But again, reiterating on what I spoke about, this in itself wouldn't necessarily be my entries unless I have enough confirmations. I don't necessarily go ahead and enter it there all the time. A lot of the times that would be my proof that, listen, the previous demand that was introduced is still valid. That's your proof. That's your break of the relative structure point to the upside. And it goes without saying, these retracements would be our entries to take this higher. And these retracements, they will line up with the significant areas of supply and demand. What do I mean when I say significant areas of supply and demand? If this market started to create a reaccumulation, as it broke that structure to the upside, chances are it's going to go ahead and react off of that reaccumulation. I'll show you based on the examples. But before we get into the chart breakdown, what's the time? 5:36, yeah. Before we get into the kind of chart breakdowns exactly, I want to elaborate a little bit further on how you would manage the trade here, how you would manage your risk over here, So you can kind of know that a big part of this industry, a big part of trading and investing is managing your investments. Making money is not the most difficult aspect of this business, right? It's really not. It's retaining the capital that's the most difficult. Making money is something that practically anyone can do. I'm going to be real with you. But how many times have you grown an account and then within a few days you've blown it straight away? It's disappeared. It's about retaining the capital. And for you to retain it, you need to get good at managing your trades and managing your risk. A lot of people within these scenarios, they get extremely lost because they want to identify the best risk to reward. They would want to enter it there and then and have a 2-pip stop loss because they've seen that that's possible and they would want to take it to the upside. And you would see that your direction is spot on. So every single time you can identify direction correctly, but also every single time you're getting stopped out before the market moves in your desired direction. I'm going to give you a very simple solution to that. Pay very, very close attention to what I'm about to say. If I know that I want to go ahead and buy this at that level over there, right? Let me change this to blue. If I know that I want to go ahead and buy this at that level, because that's my institutional candle or whatever it may be, I would have one entry that's going to be the biggest stop loss trade, whatever that entry and stop loss is going to be, right? One entry with the biggest stop loss, right? So which means one of my entries is going to be the largest stop and the most minimal possible risk to reward, right? And then I would divide my risk accordingly for the better positions. And here's the example that I would make. Let's say over here, you have an institutional candle in the middle of the range, and you want to go ahead and take your trades based on that. One of your entries could be at the institutional candle with stop losses below that major structure point. And another one of the riskier entries could be the same entries, but your stop losses, for example, at the low of that candle or a little bit below that. And what you are doing in this case is you're dividing your risk into 2 positions with 2 different stop losses, but the same entries. Sometimes it could be 2 different entries, but the same stop losses, 2 different entries and 2 different stop losses. The point is I'm dividing my risk in 2 or 3 positions. So if you normally execute a 1.0, in these 2 scenarios, you're going to do a 0.5 and a 0.5. So the total risk on the account stays the same. Well, obviously, calculate your risks accordingly based on the stop losses that you see over here. So half of your risk and half of your normal risk. The risk on the account stays the same. But what this will stop you from is that element of greed. How many times have you had the major trade play out and you miss out on a 1 to 5 or a 1 to 10 because you were waiting on that 1 to 8? In this scenario, you're going to catch that 1 to 10. So that fear of missing out instantly is going to disappear. You're still going to be in that trade. You're still going to increase your capital, and have that return on investment. And the risk on the account is also going to be the same. So if you're wrong on your trades, you're not going to lose any more money than you're willing to lose, if that makes sense. Your risk stays consistent. And if both of them play out, then hallelujah, right? Phenomenal. You're going to make your money. Amazing. So start to manage your trades properly and start to manage your risk properly. That's point number 1 that I wanted to mention, that if you look at a chart and you feel like, I don't know where I want to have my entry and stop loss, assume the biggest stop loss and assume the smallest risk to reward. If you're happy with the stop loss and the risk to reward, execute the trade, and then look for refinements. Another thing that I'm going to add to this is areas of target. In this specific scenario, you have to remember where you would want to be targeting, right? Because in this specific scenario, as the market is in a way reversing and going back up, you're taking the trade based on the lower time frame break of structure to the upside. So now, let's say if the bigger trend is on the, let's say, for example, H1, but the lower time frame trend coming back down over here, let's say that's, for example, on the 10-minute time frame, right? If these are the stuff that you're able to now identify, you have to now see that you're taking the trade based on a break above the 10-minute minus structure coming back down, which means you're taking the trade based on a 10-minute breaker structure. The higher time frames could still be respecting the bearish trend that's kind of forming, right? It's a higher probability that it breaks that structure and it's going to go higher, but you have to manage your trades accordingly. And what I mean by that is because you're trading it based on a 10-minute break of structure, your first set of targets would have to be based on the 10-minute time frame. So in this specific scenario, you would have to start to take positions off the table as this market reaches that high, as this market starts to get to the major areas of supply and demand on that specific time frame. I'm good with the notes. Okay, so let's start to actually have a look at the charts and have a look at examples for this and exactly how we can well, how we have seen the charts move and how you can start to look at the charts from this perspective from today onwards. I'm going to go through a few different examples over here. I'm going to cover a few different things. So we're going to go through Euro JPY. We're also going to cover GBP USD. Obviously, we're going to cover GBP USD, and we're going to cover AUD JPY as well. Now, truth be told, I wasn't actually going to go through chart breakdowns myself. I was going to leave that completely to Vishal. But as I was kind of going through some of the past trades and documentations, I came across a few of them that actually applied perfect to this training. So it would have been rude of me to not cover it. Let me put it that way. So let's start off with Euro JPY, right? This is kind of like obviously a very basic one, a very straightforward one, where on the higher time frames you could kind of see those elements of manipulations to the downside. We've taken these lows on the higher time frames. This market has now reversed and has broken above these significant structure points. Over there it hadn't yet, but over there it did. So naturally, the original kind of bias on Euro JPY was bullish. We should kind of be expecting some type of a bullish move. And this is where kind of this first picture comes into place. And this is documentation from some time ago. So we're talking January 12th this year. So around February, March, April, 3 months ago exactly, more or less. So this is the first picture where this was kind of generally what was identified. The 8-hour time frame is what we're looking at right now. Weekly manipulations of the lows, daily upside and break of structure, bullish. That's exactly what we spoke about. The manipulation of the lows over here, that break of structure to the upside that was taking place right over here, right? That break of that structure point to the upside. Now the market is starting to shift in that higher time frame momentum. And looking at the specific picture that we were analyzing, we can identify this even final trend. So check this out. You can see your major points, your major trend. You can see your little minor trends coming back down over here, right? And then you can obviously see the break of that minor structure point to the upside as well. So far, so good. We've gotten exactly kind of where everything that we wanted to get, really. And now check this out. This in itself over here should have proved as an area of supply. Not only that, this entire area up here, this entire level, this is our round off, right? So we have supply over here and we have supply right over there as well. The point is the second circle, the second area of supply is a very substantial supply. This market took time and it did distribute. It was within this distribution phase over there, more or less, right? Kind of turn into a reaccumulation later on, but that is a very strong area of supply over there. So as this now is starting to break lower, as this now is starting to challenge these minor structure points to the downside, the question is, what sponsored that? What took this lower? There's a lot of levels in the middle. I'm going to shift my focus to this institutional candle on the top of that range. It was more or less that candle that was the final push to the upside. And you can see the market completely collapsed before then. And you know why I see that candle as a strong one? Because this market was finding it difficult to break above it. Can you see? It was finding it difficult to approach these levels and start to break above it. It kept approaching it, getting closer and closer to it, even manipulating the highs or creating equal highs, but it most definitely didn't want to break it up until this candle, up until what we started to form over here. An extremely substantial candle over there. The 8-hour institutional candle, such a strong move to the downside over there and a reversal straight after that. This area is now your newfound area of demand over here. Why? Because this is where we introduced demand. This is where the market makers, or let's say the institutions, were reaccumulating on the lower time frames or pushing the market down to give themselves a better entry points for these buys to the upside. And it was this area of demand that has now gone ahead and crossed above the previous areas of supply. So that area of demand down there, this 8-hour institutional candle, is our newfound area of demand. That is the demand that pushed the market higher than where it was struggling to go above. That's the demand that pushed the market higher than this entire redistribution phase and these institutional areas in the middle. That was the demand that in a way sponsored that move to the upside. So I've got the demand. Now I want to see if the demand is still valid. So what you see over here is what I have written over there. 8-hour bullish. We've got our institutional candle as a point of interest. Remember, it doesn't have to come down there. Pay attention to price action. That's what I've written over there, because not always it will come down there. Sometimes it can reaccumulate and then go higher. For example, when you look at this specific level, when you look at just this picture, there is another level at the top as well, which is kind of quite attractive for entry. Let's see if I can, I don't think I can annotate on the same screen. So let's come back here. Looking at this reaccumulation, if I put this in replay mode, or potential reaccumulation, right? Looking at this structure that's forming over there, this area in itself would actually be an attractive area for buys to the upside. This area would be an attractive area because at the end of the day, you can see your lower time frame trends. You can see this was your final accumulation pushing higher. So I now want to wait for what we call that proof, the validity. If I want to buy it from here, I still kind of need to see my validity. I want to see that that demand is valid. If I want to buy it from down here, I still want to see that that demand is valid as well. In this specific picture, we started to actually form these drop base drops as the market started to approach these first areas of demand. Can you see how new redistribution was introduced to potentially invalidate that previous accumulation? Looking at this on the 8-hour time frames, or let's say 12 hours, probably going to be the nice one over here. Yeah, these are your candles in the middle of the range. And even looking at this structure over here, you can see that we've taken the highs. It's manipulated the highs. That wick over here, that's taken the highs and it's ready to go lower. Studying this on the lower time frames, I'll leave this up to you guys to do this for yourself. That in itself is now your area of redistribution. If you want to know the date and time for it, roughly we're talking 12th of January this year at around, let's say 8 p.m. UK time, right? So let's say towards the end of the day. That area is an entire redistribution area. I want to encourage you to go ahead and mark that up and study that for yourself. We've got enough redistribution videos on my YouTube channel as well. But when I start to see things like this, when I start to see on the lower time frames, especially that we are taking the highs, this is taking the highs, it's manipulating the highs and reversing. It's giving me these pushes to the upside, distributing, taking the highs and reversing and maintaining the price below as well, not end up going higher. These are now in a way your guidance in a way that this is probably not going to reverse up there. So I had that 8-hour point of interest in mind and I thought to myself, you know what, that's a strong area. We kind of need to see proof at that level. So once we approach this level, I want to see the lower time frame break of structure to the upside. I'm going to repeat that one more time. When we approach that level, I want to see those lower time frame breaks of structure to the upside. So I've got my 8-hour marked up, and that was again the picture January 12th that was taken. So we've got that point of interest marked up, and now we've gone ahead and have approached that level over here. This second picture is January 20th. So it's just over a week after the first picture was taken, and this is throughout London session over there. So this was in a way where the market started to approach that desired level and started to create the accumulation schematics on the lower time frames. Now, I'm very honest with my markups. I was hoping for a more defined accumulation. I was hoping for this accumulation to look a little bit better and a little bit easier to read. But in reality, it wasn't as easy as I wanted it to be to spot it. And it was something that we would be able to see happen once the market moved away. So check this out. This whole red area down here is that 8-hour point of interest. On the 8-hour time frame, on the lower time frames, you can see the market is trending as it's approaching our POIs. Let me just delete these things that we don't need. The market is trending as it's approaching these points of interest. It's coming lower and lower and lower. And over here, when it accumulated and it took off so impulsively and so aggressively, this is now your bullish confirmation. This is now in a way where the market is telling you, hey, I'm probably going to reverse from this level. So when you look at this picture, this is taken on the same time frame, on the 15 minutes. There is one area that I've highlighted right over there, because this, to me, in my eyes, that was where we introduced the final supply, right where my mouse is, the final supply for this to go ahead and take the lows, go ahead and create that spring to the downside. So a break above that level is going to be a significant one. A break above this level is going to be the significant one. So if I am to take these trades, I have to wait for these lower time frames to break structure before I do it. And when you look at this, this market rallied away from our level. This is now your proof of demand. This is now where the market is saying, hey, that demand is valid. The order flow is valid. We are gonna go higher. When I start to see these moves away from these levels, it gives me that confidence. And surprise, surprise, what did that look like on the lower time frames? Let's go back. Remember the area that I just highlighted? So I said a break above where? Right over here. Break above there. What did we do right before it started to break above there? That entire blue region that I've highlighted, that's your reaccumulation range. That's where the market in a way created a rally-based rally and started to break above those levels. So when you look at that picture on the higher time frames, surprise, surprise, you would be able to see, or probably on the hourly a little bit easier, you can even see on the 4-hour your base, and on the hourly time frame, much cleaner in terms of your rally base rally. Now it's a little bit too many bases in the middle. It depends how you want to trade it for yourself, but on the 1 hour, 2 hour, 4 hour time frames, you can clearly see how it's created the low, reversed back up, started the reaccumulation range, and it took off. It was this reaccumulation that sponsored the entire move to the upside. The market went sideways and it took off. Is it a surprise to see it back down at these levels? Of course not. Of course, that shouldn't be a surprise. And those should be the areas that we would want to look at for our entries. Because now we've seen the demand on the 8-hour institutional candle. We've seen this validity proof. Therefore, we can start to look at our entries up from there. Very simple and very straightforward. These are the steps that you can take. Now, this is Euro JPY. So right over there, was hoping for a more defined accumulation, and then right back within. So this was literally where it literally came right back down to these areas of reaccumulation right over there, and it took off. Now, let me go ahead and move on to a couple more. I want to make sure I'm not talking too much so Vishal has enough time to kind of go through his stuff as well. So briefly and quickly, I want to go through GU and AJ, and then this coupled by what Vishal is going to go through hopefully should result in many breakthroughs. So GBP USD, as a lot of you know, I'm still in sell positions for GBP USD from more or less the top of the range, from that, not that high actually, no, here. These are the sell positions that I'm actually still actively within for GBP USD right now. Both of them are still open. A lot of you have seen multiple screenshots of this on my story. I've been documenting these quite well. And the last YouTube video, the second to last one, is actually about kind of the first scenario breakdown as well. So everything is over there for you guys to check it out for yourself if you want. But generally speaking, with GBP USD, let's start off on the higher time frame. So example, daily or weekly. I want to actually start off on the weekly time frame. So the weekly time frame was this manipulation of the lows and blah, blah, blah. The market went up, you know, all of these things. I'm not going to speak about it too much more. But check this out. If you were looking at this on the weekly time frame when it was happening, you probably would have actually been looking at sell positions rather than buy positions. I'll be real with you. Why is it taking so long? Yeah, trading view. Let me change time frames and see if it, there you go. So if you were looking at this on the weekly time frame at that time, it probably would have actually looked pretty attractive and pretty good for those sell positions. Why is it struggling to load the weekly time frame on replay? Well, there it is. So that's in a way your buy before sell candle, your institutional candle on the top of the range that has sponsored this move all the way to the downside. And maybe you were looking at some sell positions over here. But again, pay very close attention. As this market started to reapproach that level, so first things first, the first time it rejected it, it respected the lower time frame trend. It didn't break the trend. The first time it rejected it, it was actually still trending. The second time that it started to approach it, it was sponsored by this rally-based rally. It literally created an area of reaccumulation on the lower time frames, approaching the previous supply. So it shouldn't be a surprise to see this market break above that supply. It shouldn't be a surprise to see this rally-based rally, this area of reaccumulation, sponsor the break higher, and it also shouldn't be a surprise to see the rejections back down to these levels, to see the market want to be pulled back to these rally-based rallies or drop-based drops that are sponsoring a specific break and then moving in that given direction. So that's the first kind of picture I wanted you to see as an example on the weekly time frame. The other, in a way, the other side that I wanted to explain would be the daily time frame from that very, very high. So at the end of the day, over here, we've had supply as well, and the supply has resulted in such a strong move back down. At that area of supply up there, we can expect the market to reverse. And naturally, you've got two areas of significance. You've got this one as your drop-based drop formation. And can you see this is an example of literally what we spoke about earlier? This is still a drop-based drop formation. This is still an area of supply. The market has dropped, has gone back up, and has dropped again. That's the same. I've just identified the wicks, right? Literally the opposite of an imbalance is what I've identified over here. So we've got these two specific areas in mind because it seems to me, number one, it was this area as the high point of supply that sponsored the break below here. And it was this reaccumulation that sponsored the break below there. Or this one, or for example, this redistribution, sorry, not reaccumulation. So either way, those are areas of significance that later on we can see reversals from. But the first area, something interesting happened as the market was approaching that level. Surprise, surprise. It's yet another rally-based rally. You can literally see that on multiple different time frames. You can see two rally-based rallies. Mostly, I want to speak about this first one over here. this one. The market rallied, created the base, manipulated the lows. You see, it's taken the lows over there within this rally base rally. Within that entire range, it's gone ahead, created lows and taken the lows and reversed. That's what that looks like on the lower time frames. That's an area of reaccumulation as it's approaching your supply. If it's reaccumulating, approaching your supply, it's not going to reverse at that level, I promise you. So unless it starts to distribute after that. But now when I start to see things like that approaching that level, it pushes my eyes towards the higher level. And if we are getting those reversals from those higher levels, then obviously I can get into some lower time frame counter trend trades coming back down. Let me not elaborate on that too much right now. I don't want to get into counter trend trading. That'll be a whole other conversation, a whole other training. But very quickly and briefly for GU, this was kind of the buy scenario that was identified. So obviously we got in the sell positions from these high points. I'm not going to even touch on these. There's full breakdowns available for you guys to see. But these sell positions, I wanted to, in a way, eventually look at certain buy positions. And this was one of the first pictures that I started to actually look at on the minute time frame for GBP USD. It wasn't, the entire analysis wasn't based on the minute time frame, but we did start on the lower time frames for those buy scenarios. And this was this range in the market over here. When I started to look at this specific range, it was quite interesting to see what took place exactly over here. There was a reason why I thought to myself, this could be the bottom of that range, the bottom of the market, simply because it was happily trending lower. It was happily introducing supply and going lower. Then all of a sudden it went, nope, and it went all the way back up, invalidated some, minor areas of supply, but it was liking it. It was kind of spending time on the other side of the zone. So it wasn't just the manipulation of the highs for this to kind of reverse and come all the way back down. There was something more to it. So I thought to myself, you know what? This area down here, the highlighted area, is a potential area of demand. And the highlighted area is this one right over here. Give or take this region I highlighted. And the reason why I highlighted this specific region is because that would have been the manipulation of the lows. And that would have been this final area over here that sponsored that move to the upside. And I thought to myself, you know what? This is where we're going to get reversals. I thought to myself, the market is going to give us the reversal at that exact level. Funnily enough, it went below. And I want to also help you to not get caught out on these trades because we did it. That should not have been your entries over there. This is your proof of demand, or this is your validity. The market's showing that, hey, we have had demand over here, but over here, it didn't necessarily reverse exactly at that level. These wouldn't have been the trades that we would have taken anyway. These trades are invalidated. Well, not valid in my opinion. Heavy counter trend scenarios, you have to wait for the proof and then trade accordingly. So it didn't really matter to me that we reached below that previous area of demand because it still reversed and it gave me the proof. It was just telling me that, hey, we just wanted to take the other low as well. We just wanted to also grab whatever liquidity was resting below there. So it's still okay. The demand is still valid. And when I see that reversal to the upside over there, it gives me the confidence now on the lower time frames, for example, we can look at this. It gives me the confidence that, okay, this is now valid demand. The market has gone ahead and invalidated many of these specific areas. And this would be kind of before and after type of screenshot. So I simply waited for that break above, waited for that proof in a way. That was our proof to the upside. We had our proof, we had our confirmations. And then if I'm not let me not go into too much detail about this exact scenario. It's a 5-second entry if I want to be real with you. So it was actually executed based on the 5-second time frame. Take a screenshot of this for yourself, please, to have that so you can see the date and time on the top over there. And you can see the pair, you can see the time frame, you can see the entry and the stop loss, and you can also see the time right before this trade would have been executed. So this would have been the buy scenarios to kind of take to the upside from here. I don't want to elaborate on this too much because I also want to encourage you guys to start to study this for yourself. You have got enough information now to start to look at these a little bit more independently. So anyway, now that you know everything from here, coupled with this screenshot, you should be able to see exactly what I'm talking about. So we've had that, we've had the proof of demand, we've had the move to the upside, and boom, that's your entry right over there and your stop loss right over here. I'm going to leave it for a few more seconds if you want to screenshot this. And then I want to go ahead and speak about the final scenario before I go ahead and pass it to Vishal, which is our AUD JPY. Again, a very old scenario. We're talking about December 21st, something that was documented actually end of last year. But again, something so beautiful that I couldn't really ignore. I wanted to include in this trade and in this analysis. Within the screenshot that you're seeing right now, again, it's very similar to what we looked at for Euro JPY. We have got the bullish trend. We've got these reaccumulations. This is a markup for the reaccumulation. And you can see that the market is kind of going higher and higher and higher. So moving to AUD JPY. And let me start on a little bit higher time frames. This is where we are talking about down here. So this was in a way a very kind of clean and clear scenario for ADT-JPY. To me, it looked like it was going through this reaccumulation scenario. We introduced demand down here. That was where the market in a way reversed, came back down, introduced demand, and went to create a new structure point, right? So when I see these pullbacks back into these levels, and not only that, we have lower time frame accumulations at these levels, it's now proving that demand to me. So now the market has rallied away, has broken the relative structure points to the upside, and started to create reaccumulations as it's traveling higher and higher and higher. So this over here is this picture, basically. And again, December 21st was when this was actually taken. Now, when you look at this picture, there's practically only one POI that you would look at, which is exactly where it's highlighted, that 30-minute institutional candle in the middle of the range. So I want to go ahead and move this to 30-minute time frame to show you why at the time of looking at the charts, there probably wouldn't have been any other areas of interest to look at, simply because that over here, this was your reaccumulation phase. The market left the reaccumulation, but it did pull back and it created this final institutional candle, and off it goes. So in a way, that's the final potential place that this can pull back to. And this entire thing, by the way, this entire range, what is this? This is your, just keep the blue one. This is your higher time frame rally, base, rally. This right over there. Can you see it now? Let's go to daily. Might be able to see it a little bit easier on daily and weekly timeframes. Right over there. You can see the markups, the shakeout, AR, BC, all of these things. So that's now a rally, base rally that has gone ahead and has created the new structure point. So obviously we can kind of expect the market to be reversing at these levels. So going back to this now on the lower timeframes, that was what I was waiting to see. I was waiting to see if that institutional area is still valid on the 30-minute time frame. Okay, so when we get this rejection up from here, I am actually just waiting for a minor break of structure to the upside. And this is where it brings me to the final screenshot right over there. Literally followed from there. December 21st at 2:15 p.m. December 21st at again 2:15 p.m. as well. Literally 2 minutes after I took this screenshot, I took this one to show again. Now I'm waiting for that final minor break of structure to the upside, that 5-minute break of structure to the upside. So let me go ahead and do this 30-minute institutional area that we were looking at. And this is now a final 5-minute breaker structure, basically. So check this out. This area that we identified over here on the 30-minute time frame, I'm going to show that to you one more time. This area down here as an institutional candle that we identified on the 30-minute time frame, as we were approaching that on the 5-minute time frame, what was it doing? It was introducing supply, and the final supply that was introduced, the final round off that in a way pushed the market lower, took whatever liquidity needed to be taken. And in a way, that was our final major area of supply or major area of structure. So I have to now kind of wait for a break above there. And that 5-minute break of structure to the upside is kind of confirming our trades. It's confirming that this market is more likely to go to the upside, more likely to start to actually reverse and go higher and higher and higher. And if that's my breaker structure to the upside, looking at what sponsored that, you will always be able to find these rally base areas and rallies that sponsor these breaks of structure. These rally base rallies turn into future points of interest for entries. And that indeed would be able to be the type of trades that you would take, really. The rally base rally that invalidated that area of supply on the lower time frames. And now I'm simply basing my trades on that. And let me just take this off replay mode to kind of make it easier. And this is the kind of final push to the upside from these levels, from that 30-minute time frame that was kind of identified. And you can see around the targets as well. I'm not going to draw my arrow from here all the way up there, right? How do I know the market's going to go all the way up there unless I'm looking at the weekly or monthly or whatever? Normally, it's about how you manage your trades. So I want to be taking the profits relative to the structure, but not all of it. I would keep positions running indefinitely. I'm still in GBP JPY buys from end of January. There's still so many scenarios that we're in from a long time ago. So with that being said, now we've kind of gone through a little step-by-step kind of guide as to what to look at. We've spoken about structure from a supply and demand perspective, rally-based rallies and drop-based drops. And not only that, we've also given 3 examples as to how you can look at your trend, look at your supply and demand, also look at your significant areas of supply and demand that are invalidating the previous ones and basing your trades on that. Trend, supply and demand, proof/validity, and then from there you look at entries. Now Vishal is going to kind of speak a little bit more about indices and the lower time frame stuff, but honestly I've been trying to again keep up with the chat family. It's so tough right now to kind of be looking at everything in the chat box. I'm trying my best, but it's impossible. There's only one major question that keeps coming through, and I feel like this is the question that so many of you have continuously asked me left, right, and center. Every single day I get messages on Instagram about this as well, even though I have posted a video, even though I've tried to make it as easy as I possibly can, and that's about our mentorship and courses and all of these things and what we do. Family, I have made this as easy as I possibly can for everyone. All you've got to do is you literally have just got to go to my website, which is pipsofpersia.com, right over there. Go to my website, pipsofpersia.com. On the website over here, don't judge, I've designed it myself just to make it easier for you guys, okay? On the website over here, you can go ahead and click on courses and mentorship and see exactly what it is that we do, get access to, get full information about exactly what it is that we do. And if you want to go ahead and get started, you can go ahead and click on partner up with us and literally just follow the information to get started. So everything is available to you on pipsofpersia.com. Now, I want to go ahead and pass it to Vishal so he can kind of start to actually break everything down. Vishal, my bro, I'm going to try my best from my end to figure out exactly what I can do to help you put the camera on. I'm going to look for settings over here and etc. But I want to go ahead and in a way help you to be able to show your face to people as well. But with that being said, I'm going to go ahead and put myself on mute. Vishal, I want you to share the knowledge with people, and I'm going to try my best to help you put on your camera.
Well, good, bro. Thank you for that. Now, bear with me whilst I share my screen. So I'm going to go over a couple of examples as well myself. Now, the first one that I actually have for you guys is a buy scenario on Euro USD. Now, looking back, it was based on an entry on this Thursday coming up. Now, if we jump from now, just a bit about how I trade before. As you guys know, if you've seen Mehdi's Pips's videos on his YouTube, he's been more of a swing trader. I'm slightly opposite in the sense that I do more intraday trades. So I like to sort of get in and out of my trades at the sort of by the end of the sessions. So that'll explain why I don't really hold a lot of my entries. But with that being said, let's continue. So looking at Euro USD from the previous day's movement over here, we can definitely see that there was some sort of structure break to the downside. There was a bearish break of structure over here. As we can see, price had moved to the downside below this previous significant high low. So that is a break of structure to the downside. And then that would definitely mean for us that there is a valid area of supply in this top area. And on the 15-minute time frame, I've just highlighted this last buy candle before the main sell-off. That buy candle before the main sell-off, and that was the main supply zone, which I had marked up. So having that as the main supply zone for our potential, continuation of these sells, we want to see this continue to carry on going down. Okay, bear with me one second, guys. Okay, can you all see me now? I think the camera should be working now. Hello, this is me. I'm not just an emoji. But yeah, cool. So going down into these lower timeframes now. Let me go back to the markup. So here was that previous supply zone, which I was talking about, thinking that we should be able to get some bearish movement. And looking at how price reacted into the area, into that supply zone, we can see that it did give a reaction. It did give a positive bearish reaction. It created, this high, this low, lower high, sort of lower, lower points, but it was still kind of consolidating, it's still moving sideways. And upon further sort of analysis, what we can see is definitely the same thing as what Mehdi was going over earlier. We've got these areas of reaccumulation taking out these areas of supply. Think about it. Supply is gonna, if supply is in the market, if it's shown to be valid in the market, price is going to be moving down from those areas. So you can definitely see the supply in these areas as price is moving down from there. But then we get to see this rally, base, rally formation, this reaccumulation, whatever you want to call it, it's there. We can see that this reaccumulation actually takes out this previous area of supply. And that for me is going to be my new point of interest for these buys. So having one entry in terms of that, then this all comes down to trade management again. So like Pips was saying earlier, we have one entry with a larger stop and having a TP, and this TP was based upon having a measured move of the previous impulse. I'm just looking to trade each impulse as I see it. So we have the same size impulse as this getting into the supply zone. And this, for me, was seeing a demand zone being valid here. So I want to see an equal size move to the upside. So we can see that impulse, retracement, impulse. So I'll be taking my profits up at this point here. So the first entry was based off of this area here for a buy. We had a good area for entry around the 1.19 level, and I moved entry slightly higher just to account for spreads. So that was one entry there. And then the second entry, if I actually go to the screenshots, so there we go, you can see the first entry there. And let me go to the next screenshot, and we can see as prices entered this area, we're getting that validity, we're getting that proof that Pips was talking about earlier. We're getting those lower time frame breaks of structure, and you can just about clock in this area, there is a fractal reaccumulation happening in this area. Your preliminary support, your selling climax, automatic rally, secondary test, sign of strength, then it busts straight down for a spring movement. It takes out these little lows in this small downtrend that we're having here, and then we see a massive movement up. And actually, if we zoom in, let me see if I can zoom in on this. There we go. So zooming in, what do we actually have in this area? We've got another rally, base rally that takes out this significant supply. Takes out that significant supply. It's a reaccumulation. So having entries based on this general area, and this second entry was a market execution. So I got in slightly above where I wanted to. I was looking to get in, really at that imbalance of that base there. So that was the next entry, and then we can see how the movement progressed afterwards. So there are the two entries there. So we've got the first entry with the larger stop and the second entry with the slightly smaller stop. I'm going to show this to you guys on TradingView just to see how important this trade management is. So obviously the first entry is with the slightly larger stop just to make sure that we are in on the trade, and that did actually reach a -1 to 3 risk to reward ratio. And then this second entry, I was having my stop loss just below this point of interest, just below the main rally-based rally that we were looking at for our point of interest. So that was where I put my stop loss. But looking back at this trade, I reckon I could have, made a lot more in terms of the percentage on this trade. Having put my stop loss here instead, that would be at the bottom of the spring of this fractal reaccumulation in this area. And instead of, achieving, there was a 1 to 3 on this first one, and then on this second trade, we were looking at I think it was another 1 to 4. Yeah, it reached 1 to 4. If I had, the risk slightly higher at this significant point here, could have, achieved a 1 to 7.5 risk to reward ratio on that trade. So that was a little reaccumulation example on EURUSD. Now the next one I'm going to go over. I know Mehdi was saying, I'm going to go over US 30, which I am. So bear with me once I find that. Okay, here we go. So US 30. Looking at the screenshots, the before screenshot I've got is on the 1 minute time frame. We can see that price is making this downtrend as we come down. So if I get back to the relevant markup, bear with me whilst I put it in replay mode so we can see it together. There we go, there's the relevant markup that we wanted. And for this US 30 trade idea, we had, this downtrend that we were seeing throughout the whole day pretty much on US 30. And, it was making lower highs, lower lows, lower highs and lower lows. And then we start to see, these significant lower highs. So this point in particular, because this went on to create a further lower low. So I had this base area marked up. Now, if I actually zoom in on this area, you can see why I was looking at this base. So, you can see we have this rally, a base of about 1, 2, 3, 4, about 5 candles, which is probably the max I'd look at for, number of candles to look at within the base. So we have a rally, a base, and then a rally that took out this significant area where supply was present. Supply was present in this area because it created further lower lows. So let me also zoom out on that. And it didn't quite get to my main point of interest. But one thing that I want you guys to understand about US 30 is that it is a stock indice. It's made up of the the top 30 performing stocks in the United States Stock Exchange. So that's made up of the New York Stock Exchange and the NASDAQ. Now, and one thing about the sort of New York Stock Exchange, the New York Stock Exchange opening times are at 2:30 p.m. British time, and I think Eastern time it's around 9:30 a.m. So that's a very prevalent, a very good time to look at these stock indices and actually see a good amount of volatility. And having that in the back of your mind should be a good thing. So this was the main POI which I wanted to see, come into there and then bounce up and get my buys in. Didn't quite get that, and just before it hit that 230 area, we saw this uptrend starting to take shape. So we had this a low, a high, a higher low, a higher high. Just before it made a higher low, thinking I'd get into my buying point of interest and then look for my entries. But then it made this higher high again. And if it's made this higher high, for it to still come back into this entry, that's not sort of an entry that I'd like to sort of take. So I had an entry based on, the next base that I saw that was available in this uptrend to buy. So we had this rally, and like Pip said earlier, this base wasn't exactly another candle within there, another institutional candle, another little doji candle, whatever it is. In this scenario, it was a rally, a base that looked like this little wick, and a rally. Now this is the significant base I want to be looking at because it's the one that took out the significant lower highs, especially this area. And that area is where it went to consolidate and then went lower, and this is the movement that took that out. Then went in for my entry just over here for the pullback on the pullback, and then we can see how price reacted up. And this is why I love trading US30. It's quick. It gives its moves quick, and around 230, you're going to be seeing a lot of areas of supply and demand manipulation and whatnot. So that was how I looked at US30 on this. Okay, cool. And the final example I actually want to show you guys is US30 again. And you see, so the before screenshot is, here we go on US30 again, 1 minute time frame. You can see it's making lower highs and lower lows coming into the area. And I've got this purple zone marked up, which I'm going to go through with you guys in a minute. That was actually a higher time frame reaccumulation point of interest area for me. So that was the before sort of screenshot that we can see. I'm not going to go too much into detail into these into the low time frame over here, because I do actually have a video outlining the whole breakdown of this entire trade on my channel as well. So looking at this on the 30-minute time frame, where are we looking? Here we go. So the 30-minute time frame for this. Now, what can we see in this area? It's the same thing happening over and over again. And I think Pips and I have said this about 20 times to each other in the past week, going over and just looking at notes and stuff. But we've got an area during this Asian session here where price failed to really break above. It's a constant area of rejection, and that to me indicates an area of supply in the market. The supply in the market is going to stop price going high. It's going to make price start dropping. So a very good area of supply in this area. And what we've got leading up to that, after that, it's either going to obey the supply and carry on going down, or we get what's happened in this scenario, this rally scenario, or this reaccumulation scenario, or this 30-minute institutional candle scenario, whatever you want to call it. We've got that acting as our point of interest. So that's going to be where I want to be looking for how price approaches that zone, and then see those lower time frame confirmations, those lower time frame analysis to really get in on that trade. So going back to the before, there we go. That's the lower time frame, the 1 minute lower highs and lower lows. After the screenshot again, you can see how it played out, and I think my actual entry was based on a 3-minute entry. So what we can see in this scenario here, as I zoom in, there you can see the lower highs and lower lows that I've marked out. You can see this last sell candle on the 3-minute time frame as it touched into the main point of interest from before. It then had a minor break of structure of this mini, we'll call it a mini downtrend. So of this mini downtrend, we've got this break of structure to the upside. and then we have the retracement back into the area. And I could have probably got a better entry, but I just entered off the open of that candle. Entry there, stops just below. And in terms of having these entries, you know, the TP. Bear with me 1 sec, guys. And as this was a reaccumulation sort of trade, most of the TPs and stuff for my reaccumulation trades is just a simple, you know, copy of the previous impulse. So we have the size of this impulse here, and having a similar size impulsive move up from my entry area. So there, so and just again, like I said, at 230, look what happens to the price of US30 at 230. You see that it gets this mad volatility spike to the upside. So another rule that I personally use is at this 230 spike, if I'm already in a trade from beforehand and it's going within my favor, I'll take some partials after this spike, just to, you know, secure some sort of profits. And then the main TP I'll be looking to take is going to be based on, you know, liquidity regions, supply and demand zones that need to be respected. In this case here, it was just a case of seeing this move down as a potential breaker structure. I think if we go to the 1 minute time frame on this, we cut the chart off again and jump back into it around there. And yeah, so after seeing this movement come down, you know, it just about went below this structural point here. So that for me was a potential break of structure. And by that time, you know, I was already around, you know, 1 to 19, 1 to 20 risk reward ratio. So as it retraces back into this imbalance, and again, it's the same thing we're seeing again and again. We've got this drop, base, drop that takes out this significant area that created a high, this significant demand that was valid at one point, got clapped by this drop, base, drop, this redistribution of price in this candle. So looking to take profits out around that point, and that was the end of that trade. But yeah, there were the main three examples that I wanted to go over. So I'll look to pass it back to Pips right now.
Appreciate you, my.
In terms of the those kill zones that you've seen on the charts, just let me share my screen. So basically, these kill zones, they just outline a very simple sort of thing. It just makes it easier for me to know when to place my trades, really. Yeah, so the shaded region, sorry, that's when the sessions actually open. So the London session, you can see it opens at 8 a.m. And the New York session, we've got this opening at 1 p.m. So this is all in British time, by the way. And this second shaded region, that's going to be all about how, you know, the New York stock market, that's what time that opens. So I've done, it opens at 2:30, but I've done, you know, half an hour each side just to give it a bit of leeway. And in terms of sort of, you know, having access to this, I think I'm not able to sort of make it public, but you know, I'll be posting the actual coding that's needed to put this onto your own trading view. I'll drop it in my Telegram chat. That'll make it easier, I think. And you can see my details from my Instagram and Telegram just below over here. But I'll drop the details for this. And what you're going to need to do is on the actual, on your trading view, you're going to want to go down into the Pine editor, and you'll find that at the bottom here. So you're going to the Pine editor here. You're going to maximize the screen, and you're going to paste this code in. So this code in, once you paste this code into here, click save, add to the chart, it will give you these same sort of kill zones, or, you know, session times, or whatever you want to call it. But yeah. So let's.
All right. We pretty much got the gist of the video. I think whenever I first, you know, introduced the way I trade with order blocks and whatnot, it's a very dumbed down version of the same thing. Rally base rally, drop base drop, you know, whatever you want to call it. It's going to give you the order block. Now, hopefully everybody understands the importance of getting tapped into a trade now, right? So if you notice, when you look at a chart, if we get an order block right here, we always want to get tapped in. Can everybody see my screen?
Yes, I can.
Yes.
See how I have the order block area marked out? Then I have the wick right here that taps you into the trade. This is nothing. I mean, it's all the same thing that that Pips was saying about how he wants to see this area hold, right? Basically, you have your area of interest here. You're waiting for price to come validate this area by testing or tapping in and moving away from the area, right? So that's why, now revisiting this, that I would always tell you to wait until you get tapped in. That's why I didn't want you to just jump in this trade, right? Because if you get a trade like this and you jump in, maybe 3 candles later, it pushes past your area, going to tap into a different order block. Okay, so I know the video today was long, right? Last week's video was long too, but the information in those 2 videos, should be enough to propel you, as a trader into a different stratosphere, right? And I know, if you're just seeing these videos for the first time, you're not going to get, all of the information. But if you just keep showing up, right? And if you go back and you watch these structured videos on your own time, you'll find that you'll start noticing, different things when it comes to trade setups and, the way you're viewing your trades in the market, right? So I'm a swing trader, right? I like to identify, higher time frame trades, right? But there are a lot of people who trade, the 4 hour or below, right? The 1 hour, the 15 minute. So if you were paying attention, there were a lot of little nuggets that were dropped on how to transfer your information and look for trades on lower time frames, right? So if you look at this GA setup, right? The monthly, right? Last month, or you got a drop, base, drop, right? So similar to the information we just received in that video, right? Drop, base, drop, right? What are we waiting on? We're waiting on price to push into our area and validate this area and push away from the trade, right? So what does that look like in real life? All right. Drop, base, the green candle, drop. Now we want the market to push back into our area to validate our trade and push away. And in this case, it happened twice, right? This is the drop, this is the base, this is the drop. You got the initial push into the area and the pull away. Then you got the second push into a lower area. And now you can see the price falling, right? You can trade these scenarios. You can trade them by hedging. You have buys and sells, right? You can buy, sell, buy, sell, buy, however you want to do it. And if you look closely, you'll see this low right here. You'll see a lower low, and then you'll see another lower low, right? Now, you'll see a high, a lower high, and then this area is a lower high. All of this is structure that's playing out in our very faces, right? Drop, base, drop, right? This came right to our POI, and pushed away. If you took this buy scenario, it went right to your take profit. Do I have any questions? What do you mean by layered, Mark? Elaborate. So whenever you see more than one order block, right? You see more than one order block in a given direction. Order block, market pushes up. There's a bearish order block that comes down and takes liquidity, right? There's a bullish order block, market goes up. It's not that that I don't want you to look at it as being layered, right? But there's a such thing as order flow that will kind of give you a hint towards the direction that the market is pushing, right? You know, and depending on what level that you're looking at, what time frame you're looking at, you're going to see several order blocks that push the market in a given direction. So in that sense, you can say that they're layered. But what I would really like for you to start doing, you know, as a trader, you need to be able to identify from a higher time frame a market direction. And once you identify the direction, you have to identify points along that direction that are significant, right? So if you think about this from a very basic standpoint, right? This candle, this month's candle, this is June, this is a June candle. But prior to the June candle, at the end of May, you see how this red May candle engulfed that green April candle and gave us a bearish order block. So from that standpoint alone, we had a directional bias, right? Like I'm coming into this month thinking that I would like to see the market push into this order block and then push away from the order block. So where is my point of interest? You have to dive into those order blocks by dropping down in your time frame, right? You need to find an area that has an imbalance or that has reason for you to look at it again, right? So this was the initial push down. This is the green candle, the April candle. This push up is the April candle. Then the May candle, right? So by the time the end of May happened, you would push further down than you did in June. So now all you're waiting on is to push into your order block. So if you think about this, right? If you think about this from the way that Alicia and Brianna trade, right? If you have this low over here, this push down broke this low, right? So now all we need is wait for this market to push up into the area that sponsored this break. And if you watch that video, you got this rally, base, rally. If I drop down, I guarantee you'll see an order block right here, right? That order block sponsored this break. This price pushed right into that order block, tapped in, pushed away. So based on this break of structure, you could have bought the market up, right? It's called a hedge trade. You buy it. Your area of interest is somewhere up here. Maybe you didn't know this exact area. Maybe you were looking at this area. It doesn't matter. If you're in a buy, you hold your buy until it breaks and goes the opposite direction. And it's not going to break on the daily. You're not looking for a daily break. again, you're dropping down time frames. If you choose the 1 hour breakup structure, that's cool. You're in a buy from down here, you're good. Maybe you bought it and you're looking for a 1 hour breakup structure in the opposite direction. You guys understand that? Awesome. So going forward, right? As a trader, you want to anticipate the moves based off of what you already know, right? Like based off of what you know as a trader, you need to start anticipating these moves. You got to anticipate where the market is heading based off of how you're reading market structure, right? In this scenario, when the market came here and gave you this low, lower low, higher low, what are you anticipating? This is a swing. This is a swing low right here, right? So based off of this formation, you could have been waiting for this pullback, right? We always talk about the 78%, you know, as a great area to hop in the trade. When you get this pullback, come right near your 78%, right? I mean, if you're anticipating this, you catch this move, right? And you're not going to catch it on the daily, right? You're going to catch it on a lower time frame. But the way you catch it on a lower time frame is you have the area marked up. Got the area marked up. And hopefully you have the area marked up before the market gets there, right? Like you know, based off of this swing low, market leaves, you know it's coming back. And where is this area? In your order block. It's in your order block. Market comes back, it's going to tap in, boom, right? There's a number of different ways you could have arrived at this scenario. And you can take this trade back to this high safely, confidently, right? So we have to get to a point that we're not reacting, right? We're not just saying, okay, I see an order block, I want to trade the order block, but where do I trade it to, right? You can trade this order block to this high or this high pretty confidently, right? But we got to get to a point where we're not just reacting to seeing an order block. We have to get to a point to where we're anticipating, okay, the market should pick me up here, right? Because this is a zone, right? So once we get there as a trader, you become much more effective, right? And your confidence is a lot greater, right? At this point, now you're just able to manage your trades, right? Like, okay, I know I can ride from here to here. My first entry, again, I don't care about how small the stop loss is. I can get a re-entry on a lower time frame with a better stop loss, and I can kill my risk reward, even if it's up to this point. Do you have any questions on what we covered today? For those of you who just made it today, I encourage you to go back and watch all three of the market structure videos, right? This last video to me was an aha moment the first time I saw it, because it kind of combined everything that I had been learning. The guy's name is Pips of Persia. to me, he's a very good instructor, right? He's very detailed, and you know, he makes the concepts a lot easier. He made them a lot easier for me to see and understand, right? And he tied everything in. So when you go and watch the video, I want you to kind of reflect on some of the trades that you've either taken or you've seen or been a part of other people taking. And to see, I want you to see if the scenario and the setups were validated in your mind when you watch the video, okay? I'm going to go ahead and end the recording of this intro to smart money concepts because we need to go into the swing trader's call.